Hello. This is Kraig Ward, founder and managing director of Bearhug Recruiting. It's November 28th, 2025, the day after Thanksgiving here in the US. And this is your monthly market update on what's shaping executive hiring across the startup ecosystem. The theme this month is simple. The market is steady, but the signals are starting to split. Some metrics are showing strength, others are showing fatigue, and because of the government shutdown, much of the official data is delayed or incomplete. That means founders and investors and operators really need to read the few clean signals that we do have with more attention to detail than usual. Each month, I break down the signals that drive hiring at the top so that you can move faster, you can see the shifts earlier, and make smarter decisions in a market that rewards discipline, timing, and clarity. So let's get into it. We're going to start, as we did last month, with tech layoffs, because for almost 3 years, this has been the biggest force shaping how talent moves in and out of the market. In November, the trend seems to be cooling. Public trackers are showing a little more than 114,000 tech employees have been laid off across 237 companies so far this year. That puts 2025 well under the 151,000 layoffs that we saw in 2024 and far below the 260,000 cuts across 2023. The year's not over yet, so we'll still have to wait and see what the actual numbers are. But after a short spike in October, the market seems to have snapped back in November with another drop in cuts. Fewer companies announced layoffs, fewer employees were affected. Volatility is easing, and the 2-year correction cycle may be nearly over. But here's the real impact. The surplus of average talent that flooded the market in 2023 and 2024 has been absorbed. The best executives were really never available and on the market anyway. And the few elite leaders who did surface, or who do surface, they get snatched up instantly. This creates a narrow hiring window where only a handful of exceptional executives are really going to be on the move at any given time, and they get scooped up fast. So it's no longer a volume market, it's a velocity market. So for founders and investors, timing is the advantage. The layoff wave has receded, but the race for transformative leadership hasn't slowed. Searches are just becoming more surgical. Now let's turn to executive hiring, because this month the pattern is very different from what we reported in October. The headline for November is all about CEO and board roles carrying the market. In October, demand for CEO searches jumped more than 50% from September. Board roles rose almost 30% in the same period. That is a decisive move at the very top of the org chart. When CEO and board demand spikes, it tells you that companies are making structural decisions. They are resetting their strategy. They're upgrading their leadership. They are preparing for a different kind of growth cycle. At the same time, go-to-market leadership demand pulled back. Marketing and sales and business development roles dropped 23% month over month compared to September. Companies are being selective about where they're investing. They're not chasing pipeline by adding more headcount. They are tightening execution and placing bigger bets on strategic leadership instead. If you look across functions in the chart, the distribution makes the story pretty clear. CEO and board hiring grew. Finance and operations held steady. Go-to-market dipped. Engineering and product stayed relatively stable. The market is shifting away from broad hiring and into targeted leadership decisions that are going to really move the needle and move the company forward. Here's the takeaway. We're in a moment where founders and investors, they want a lot more control at the top. CEO upgrades, board upgrades, strategic operators who can steer the business through a macro environment that's really mixed. Go-to-market hiring will return, but right now the appetite is highest for leaders who really shape the direction of the entire company. So now let's talk about venture capital, because this is still where the shift is most dramatic. The short version has not changed. The money is still going to AI, and that's not going to stop. In the first half of 2025, and Q3 data reaffirms the pattern, AI startups are capturing over 64% of US venture dollars and roughly 53% of global venture dollars. That added up to more than 377 billion on an annualized run rate, already ahead of the entire year of 2024. More than 10,000 AI deals have been completed this year, and the average deal size is close to $36 million, which is double last year and 4 times what we saw in 2023. Meanwhile, the rest of the market is still starving. Traditional SaaS rounds over $100 million have collapsed from 147 in 2021 to only 21 in the past 12 months. Non-AI software is raising far less money, and the threshold for getting funding, it keeps rising. So yes, a lot of these AI companies are really AI-powered SaaS companies. That still does not change the math. The dollars have moved, and they have stayed moved. This is the new ruthless that Orlando Bravo talks about. Investors aren't chasing growth anymore. They're chasing defensibility and true differentiation. They want data moats. They want AI native value creation. So if you're a founder, the message, as we will repeat again from last month, is pretty loud and clear. Being AI enabled isn't enough anymore. You either build something that could not exist without AI, or you accept that you're competing in a much smaller capital market. Let's take a look now at company creation, because this is the foundation for everything else in the market. And while I was expecting we'd get net new data for Q1 of 2025, because there's a 3-quarter lag, at the end of October, because of the government shutdown, we'll have to wait a bit longer, but hopefully they'll be caught up and we'll have that data sometime in December. For now, to repeat what we shared last month, startup formation peaked at the end of 2021 when nearly 376,000 new establishments were created in a single quarter, the highest level ever recorded. Since then, formation has cooled and leveled out around 322,000 per quarter. It is still healthy, but nowhere near the breakneck pace of the stimulus period. On the other side of the curve, closures spiked through 2022 and 2023 as weaker companies finally ran out of room, but those closures have continued to moderate. The shakeout is mostly over. What remains is a more stable, more durable cycle driven by stronger, better built companies. The trend from what we can tell today is pretty clear. Net business creation is still positive, but the growth curve has matured. Companies being formed today are more disciplined from day one. They're raising less, they're hiring a lot smarter, and they're designing for capital efficiency instead of burn. For executive hiring, that shift does matter. There may be fewer open seats across the market, but the seats that do open will demand leaders who make an immediate impact. Leaders who are AI fluent, they're able to execute with lean teams and tight budgets. Efficiency is not a constraint anymore, it's an advantage. Let's shift now and talk about the broader US job market and the mess around the data this month. Normally, by now, we'd have the official October payroll report from the Bureau of Labor Statistics, but because the federal shutdown interrupted that data collection process, the October release was delayed and its accuracy is constrained. So for September, which is the most recent fully published month, the economy added 119,000 jobs, which is higher than the analyst expected, but with a huge caveat because the unemployment rate rose to 4.4%. So here's what I think is beneath the headline. The revisions that show hiring in July and August was cut much deeper than previously thought. And although jobs were added in September, the overall trend is one of stalling growth, not acceleration. The data gap means hiring leaders must assume weaker future mobility, longer approval cycles, and heightened candidate hesitation. For founders and hiring teams, the message is pretty stark. The job market hasn't collapsed, but it's stopped expanding. Hiring is no longer about tapping into a rising tide. It's about making deliberate moves in kind of a flat sea. If you move now, you can still secure leaders who will matter in the next phase. If you wait too long, you're going to face a quiet market where detached candidates are going to hold the power. So timing really is everything. Now let's turn to unemployment claims and the broader labor market read, because these are the only indicators still updating cleanly while the other data sets are frozen. The September jobs report finally came out almost 2 months late because of the government shutdown, and it delivered a mixed picture. The economy added 119,000 jobs, which was more than double expectations and the strongest gain in 5 months. But as I mentioned, unemployment also rose to 4.4%. That combination reflects both more people re-entering the workforce and more people losing jobs. Weekly claims data tells the same story. Claims remain historically low, but the baseline is drifting higher. Hiring isn't collapsing, it's kind of slowing. Friction is rising, and confidence, I would say, is a little bit softer. With October job numbers delayed until after the Fed meeting in December and the possibility that some inflation data may never be released, this September report is one of the only official signs founders and investors have to work with. So the takeaway is that companies are not firing in waves, but they're not hiring aggressively either. Approval cycles are stretching. Candidates are more cautious. The velocity of leadership hiring, as we talked about, is shifting. So for founders building growth stage teams, this means the window to land top operators is still open, but it's not really going to get wider. The pool hasn't really grown, and the urgency to move has. So the labor market is stable, but momentum has slipped, and this is a time to really act decisively and not wait for clarity. So I want to shift now and just talk about the three biggest hiring challenges we see constantly with startups and the CEOs running those startups. The first is attracting top executive talent without overpaying. Startups can't match what these big AI companies are paying, like Meta and OpenAI and other big tech companies, on cash. They have to win on mission, on equity, on their product conviction, their strategic narrative, and they've got to overcome doubts about startup risk and exit potential. The second challenge is finding the right stage fit leader. Not every seasoned executive can operate in an early stage company with chaos and ambiguity. CEOs need someone who's scaled from 5 to 50 million, not 500 million, and who won't over-engineer things or require Google-level team resources to get anything done. The third challenge is running a high-stakes hiring process while running the business. Executive search requires extreme precision. The candidate target addressable market are small, so you have to use scorecards. You got to do very, very, very strategic sourcing from a very limited pool of people. You've got to use very creative and very aggressive outreach and weave the proper story and work with extremely tight interview windows and coordinate them well across the internal team and the investors, all while the CEOs are already stretched way too thin. A mishire at this stage isn't just a delay, it's a major setback, so the right partner is essential to avoid balls being dropped. And lastly, I'll share the three most common critical talent gaps that are blocking early and growth stage startups from unlocking that 100 million in revenue scale. The first major talent gap is attracting go-to-market leaders who can balance both strategy and execution, who can act as both a coach and a player. Too many teams lack leaders who can build repeatable sales motions, navigate really complex B2B buying cycles, and align product, sales, and customer success around one unified go-to-market plan. The second major talent gap is prioritizing and successfully hiring those strategic finance leaders. It is so common to meet CEOs who wait way too long to bring in a strong finance leader, someone who can build smart compensation and forecasting models, integrate all their disparate fragmented systems, and bring a level of discipline to their financial planning. Without this leadership, CEOs are going to struggle to model their growth, manage burn, and make confident data-backed capital decisions. The third major talent gap is hiring a cross-functional product leader. Vision and engineering chops or fundraising skills alone aren't enough. Many startups need a product leader who's fluent in agentic AI, can prioritize across diverse customer types, can drive delivery and scale the team without creating chaos. These roles, go-to-market, finance, and product, are the hardest to get right and the most essential for early stage startups looking to unlock $100 million in revenue scale. Speaking of which, if you or anyone in your network needs help hiring, it's important to know that most executive search firms still are kind of operating in the past. They're slow, they're expensive, they're kind of built for the enterprise. They're not really built for fast-moving, resource-constrained early-stage startups. At Bearhug, we've re-engineered executive search from the ground up. We've integrated modern tooling, smart automation, and a fresh approach to deal structure, all designed to match the speed, the budget, and the realities of early and growth stage teams who are looking to unlock that $100 million in revenue scale. We call our approach the easy button. This model is guaranteed to deliver you with 2 or more executive level candidates chosen off our slate within 30 days who will be advanced to at least stage 3 of your interview loop, or you're not going to pay us a penny. And keep in mind, these aren't active job seekers. They're the top 10% executives vetted against your exact requirements, scored, and fully written up. They'll show up to their first interview pre-qualified, pre-educated, and pitching you on why they're the right person to hire, even though just days earlier, these people had zero intention of leaving their current role or entertaining something new. We enable you and your team to stay focused on unlocking that $100 million in revenue scale while we handle 90% of the heavy lifting and only have you engage in the 10% of the search that's critical and that matters the most. This way, you and your team can stay focused on accelerating product market fit, creating a fantastic customer experience, and accelerating your business growth. Based on historical averages, you should only need to interview 3 to 4 people off our candidate slate to make a placement. And while we've finished executive searches in as little as 9 days, it's safe to plan on it taking roughly 45 days from kickoff to getting a signed offer letter, which is still 2.7 times faster than the industry average for executive search. Lastly, you can plan on advancing at least 80% of the candidates that you choose off our slate to the second round of your interview loop, which demonstrates just how well our candidates will match what you're looking for. One thing that often surprises both clients and their investors, and that we believe will surprise you, is the level of transparency that we provide. From day one, we deliver a metrics-driven summary of every key action, updated weekly, along with real-time visibility into how the talent pipeline is progressing. This allows us to iterate quickly if needed and bring each key stakeholder into the process at exactly the right moment to help get the ball across the goal line. And the best part, we know trust has to be earned. And to prove our model works, for select new clients, we're willing to front load the work on the first search that we work on together and defer our engagement fee until interviews begin with top picks from our initial candidate slate. Plus, every invoice that we send is always tied to pre-agreed upon performance milestones. For the record, engaging with Bearhug won't feel like a high-pressure sales pitch. Our focus is on leading meaningful strategy-driven conversations with founders and their investment teams who understand that great leadership isn't just important, it's the moat. The best outcomes come when the right executives are all rowing in the same direction, and that kind of alignment doesn't happen by accident. You and your backers are already thinking about replacing or adding a key executive to your team, and working with Bearhug will just make that process easier. So if you're a hands-on investor looking to de-risk your portfolio, or a founder who's ready to unlock that $100 million in revenue scale, let's talk. To kick things off, we'll swap notes on what we're both seeing in the market. Then I'll walk you through exactly how the easy button MSA works in practice, and I'll share our frameworks, our tools, and our referral systems, all useful whether we end up collaborating or not. Go ahead and use the link provided to book a call, shoot us an email, or pick up the phone, and let's explore what's possible. I'm really looking forward to the conversation.